What's going on, guys? Welcome to this video on harmonics. I'm going to cover what they are and how I use them. I've put this cheat sheet together here full of top tips to help you leverage the harmonics, understand the harmonics, and then be able to take entry and profit with the harmonics. So I'm going to go through this sheet first, guys, cover everything in here, then we'll take it over onto the charts. And this there'll be a link to this sheet or this Google Drive folder here underneath the video, so you can get to this sheet and you can also get to these harmonic diagrams here. So harmonics, guys, are a result of natural order flow of the market. I use harmonics on the higher time frames to give me a directional bias, or to use as a PRZ, potential reversal zone, with other confluences. I don't just take trades from the D point specifically. We have to have other confluences, and we'll cover that shortly. So top tips, guys, if you're brand new to harmonics, choose one and become good at that one. Don't attempt to learn them all at once. It becomes mind-blowing and mind-boggling and so confusing, and that's exactly what I did in the beginning. Harmonics are actually one of the first strategies that I learned, and it took me 6 months or a year to even familiarize myself with them. It was so confusing, because if you look at this, there's so many, and this isn't even all of them either. And when you're trying to, learn all of these, because there's bullish and bearish, so you get the bullish bat, the bearish bat, bullish Gartley, bearish Gartley, bullish crab, bearish crab, etc., cipher, ABCD extension, etc. The easiest thing to do is just find one and learn it. I actually started off learning, the bat pattern because it was the easiest, simplest one to learn, but that's not actually one of my favorite ones, and I'll cover that why when we go through this sheet. So my favorite ones, guys, are the shark, the crab, and the butterfly. And the reason for this is because I like extension patterns. With low time frame wick confirmations, guys, will pay out 90+% of the time if you get the timing correct as well. And mainly why I love these the most is because they've broken previous structure and they're sitting on a psychological level and they need to retrace. So I've just covered this. The easiest way to learn how to start seeing these naturally without thought is to pick one and backtest it on the charts until you can see it like this. So it becomes natural for you. Using the TradingView harmonic tool, which we'll cover here. I've got some marked up here. And when I first started, learning harmonics, it was very annoying because I didn't know this tool existed. And I used to measure with the Fibonacci, say for example, and I used to have to draw them all out manually and leave the Fibonacci measurements there so people could see. So I'd be like this, I'd have my Fibonacci tool, I'd be going from the high to low here, for example, and I'd be seeing that was just under a 50% retracement there, and then I'd be like this, I'd have to take all my measurements off, and then I'd leave the 50% there, or I'd mark it down so it was more precise. And then what I'd do is I'd use the triangle tool and I'd mark up, the harmonic like this. But I discovered this tool, and it's been a lifesaver, to be honest, the XABCD pattern, and we'll cover this in a minute. And it makes it so easy because you can see visually the measurements there, so you already know which kind of pattern, if it's right, wrong, before you even start measuring with the Fibonacci, so you don't need to measure with the Fibonacci, essentially. So the D points, guys, of the harmonics ideally should land on some form of supply or demand. This gives you two confluences straight away that you've got a good potential reversal zone. We can then use the low time frames or wicks to confirm our entries, and I'll cover this as we go through the video. So we've got the X point, A, B, C, and D. The X point is the origin of the harmonic, so the starting point, and the A, B, C, and D are the following measurements that create the harmonic, with the D point being the completed pattern and the potential PRZ. So the B point retracement, guys, this is what I think, or projecting ahead of time. This is also what harmonics help you do. Here, look, we're projecting ahead of time. We've got a D point here. So this would be the first completion of the shark pattern. We've got a D point and a 1.13. If we go on to the harmonics here, and let's go on the bearish one. Where's the shark? You can see here, look, it can be an 886 or a 1.13 or anything in between that. So it could be here. You do tend to find more accurate measurements when price lands directly on the price, but you got to remember, like, past doesn't always mean the future. These patterns do work with a really high success rate, but sometimes they give you a zone to work in, so it gives us, this is why we use the confluences. So if it lands in this potential zone here, we've then got this zone here to look for orders in. If we get a rejection there, break a structure, low time frame entry, wicks, whatever, we can then take that down. But normally what I find when I get to the 886 on the shark pattern, especially like this is on a downtrend look, so we'd be looking for a downtrend continuation ideally. What I normally find is price comes down to about here, and then it'll go up, it'll spike up, wick up into the 1.13, and then it'll make the main move and come down and continue. Or what will happen is it breaks the structure after it's rejected from the 886. You'll normally always get a retracement or a good entry from the 886, but it's normally not the main move. But you can still catch some good pips on there, and I'll show you how to manage the risk and stuff and get in and out of those later on. But you'll normally find that this is an inducement move, which basically makes people go short here, and then the real move comes after this one because everyone's gone short for the swing, targeting the lows, targeting new lows. But then what happens is price comes up, takes all these people out, and then the real move continues down here, and that's after it's tapped into the 1.13. So when I see a shark, I always look for the 2 points. If we do get strong rejection, I'll always take entries if we do get confirmation of both. Normally I'll get the smaller entries. It doesn't happen every time. It doesn't always go up to 1.13 because this is still in downtrend structure. This is basically just an 886 retracement, and you just got basically the pattern here, to confirm that at the D point. Gives you more security, and it also lands within this strong supply zone here, and then all we'll be looking for then is the confirmation of timing and the wicks, etc. So if we go back onto the sheet now, once price starts breaking below or above the B point, then you want to start projecting ahead of time towards the D point. This is when you can look to trade the C to D leg, but this is more advanced. So if I was you and you're a beginner and you don't really know harmonics, you don't really understand the market yet, just wait for D point confirmations. Otherwise, you'll find yourself getting probably stopped out here with price action. Even if you get the direction right, you probably find that you get in at the wrong time and you get stopped out, and then price goes in your direction. It's just annoying. You've over leveraged, maybe lost some money, etc. So the biggest key with harmonics is just to be patient, wait for price to come to you, and do not get in until you've got confirmation. Even when the price completes, you might get a rejection, but don't jump in with that rejection. Don't trade with emotion. You'll always find that rejection comes back and it will retest your zone, and we'll go through this again, and then you can get in on the proper entry. There's never a rush to get in the market. It's people that rush to get in the market with FOMO that end up blowing their accounts and hitting the stop losses, etc., etc. If you miss the move, it doesn't matter. There's endless opportunities in the market, guys. And if you're not sure on the pattern, don't trade it. Always wait for something obvious. Always be patient and wait for something obvious to show up. Why throw money into the market if you're unsure, guys? We're here to make money, not gamble. We're here to take the gambler's money, essentially. With Forex and trading in any market, for you to make money, somebody else has got to lose money. So, lower time frame entries, guys, and wicks at the D point. You want to see, ideally, 3 to 4 candles of rejection close to the D point before entering. So once price gets into the D point, once we've got the confirmations here, which we'll cover, you then want to see 3 to 4 candles of reaction close to that D point, in around your PRZ. So we'd be looking for 3 to 4 wicks of reaction here. So we'll be looking for like a mini schematic. We'll be looking for something that looks like this on a smaller scale though, and then we'll be looking for a stop hunt, and then we'll be looking down. And this is where we'll be looking to enter here. So what we see here is we see price stalling out. Price is failing to break above this high here. I'll show you some actual examples on the charts in a minute as we get down. Once you see price, testing, failing, maybe breaking some internal structure here, you can then, start preparing to go short. You're not always going to get this liquidity hunt, but it's if you wait for the liquidity hunts, you will miss some moves, but you will have a higher potential. You will have a higher win rate on your trades. Sorry. And what we can also do, guys, when you get more advanced, you don't need to do this in the beginning. All you need to do is keep it simple. Look for the wicks. But if you want to go more advanced, we can zoom down and look for internal breaks of structure, change a character, break momentum, some form of schematic, etc., etc. This just helps increase your risk to reward. It's not essential in the beginning. The only thing it's essential in the beginning is just keeping it simple. As it says here, zooming down is not essential, but it helps you, as you become more advanced with your risk reward, etc., etc. But in the beginning, just keep it simple, guys. And remember, timing is crucial here. You'll only see these moves here and the changing directions during these time zones here. So London open, London session, New York open, New York session. That is the main times of the day where the most liquidity is injected into the market, and you'll find that most news, especially the dollar and the GBP news, comes out around that time. So you get most market manipulation, liquidity fed into the market, during those hours. That's why they use these time slots, for these liquidity hunts and fake outs, shakeouts, etc., etc. So taking profits, guys. For profit target using harmonics, always use the A to D measurement or target previous higher lows. You want to make sure that your risk to reward is always at least 1-to-1, and set your profit target slightly below the fib measurements or previous structure, because you find that a lot of the time price comes very close to your TP if you set it right on the structural points, and then it'll actually reverse and then go back to entry, or maybe go into drawdown, etc., etc. And sometimes you actually miss out on your profit and end up going and hitting your stop loss or something like this. Or if you moved it to break even, it'll stop your break even, and then it'll go down, and hit your take profit. And there's nothing more annoying than that. So you can take partials there. So if we got confirmation here and you was going for a swing entry with this harmonic, we would use these targets here. So if price actually reversed here, or if it reversed here, wherever it reversed, if it reversed there, we would then do the A to D take profit from there. Wherever we get our entry confirmation, that's the D point. Whether it's 886 or the 113 or whichever harmonic you're using, we do A to D take profit, and we've then got our take profit targets here for our swing. So once we get our entry confirmation here, we can then put the stop above the previous high after the manipulation, and then we can target these lows here. And as you come down, the 318, 50%, 70, 886, etc. You can take partials there. You don't have to hold it the entire way. Normally when it gets to 382, I'll take, depending on how the trade's running, if it's pumping very fast, I'll only take 50% out. If it's running really slow, it's like trickling down, I'll take 75% out and move the stop to break even. All about protecting the account. So then my account will look like this, and if it continues down, it continues down. If it goes up, it doesn't matter. I've already took the profit out of the trade. But if you wanted to zoom down and was refining the entries a little more, what you could do, if you didn't want to hold swings, say for example if it came up here and this was the D point here and it reversed, we could go on the hourly, say for example, just to keep it simple. And if this was the last structural point here, we would then target this. If we entered here, we would then target this as our first take profit. 1 second. So say if we entered here, for example, out of this distribution, we would then basically have our first target here, which would give us around a 1-to-1 risk reward, and then we target the next structural points as our targets. So if we did the first one there, second one would be here. Look, we've got another zone liquidity here, so you could put your take profit just above there again. So instead of targeting it here, you target it here. So you put it just above the liquidity zone. So it'd be like TP. And then this one here, you put it just above here. Like if that breaks out and goes to D point and completes, we'll have some probably imbalance and stuff here. So wherever it breaks out and breaks the structure, ideally you want your TP, you'd have your TP just above there. Because if you have it below here or inside this zone, you'll find the price will come down, it'll get close to it, and then it'll probably go here and then down. Markets are always looking to take your money and trick you out. But if you understand the intentions behind the market, it will help you avoid this trickery. And Wyckoff is one of the things that will really help you do that, which is basically when you come up to the zone like this, so you come up to the D point, and you'll see price just rejecting from a zone here, and it'll spike up, come down quickly into the zone, reject again, and then go down. This here would be a perfect entry point. And again, once it breaks the structure below again, you've got another perfect entry point here. And you can take them with high amounts of confidence, knowing that the market manipulation, it's just done what it needed to do, and then now it's heading off down in this direction to continue the higher time frame trend, etc., etc. Just make sure that you use proper risk management. Make sure that you use at least a 1-to-1 risk reward. So if you've got a 65 pip stop loss there, which is big, make sure you want at least a 65 pip to profit. You don't want to be like these groups that use they basically trade like this. There's a few of them, and like I absolutely hate them. They'll drop signals like this. I've actually seen a 300 pip stop loss for a 20 pip TP1, and it was funny because they actually updated the group, and when they dropped the signal went like this, and it went literally. The price actually went, and it actually hit the stop loss, and then 2 weeks later it came back into the profit, and then they actually posted TP1 hit in their group, and I was like, you fucking honestly, there's so many lies and bullshitters and scammers on the internet, and a lot of them claim this 90% accuracy, and that's because they drop trades like this. It's easy to be right 90% of the time when you've got a risk reward ratio that's fucking 0.08 like this. Especially if you're trading above structural points, like. The chances of you hitting that are obviously a lot higher than hitting this. But once you, say for example, if you, have a 10 pip TP1, just say that's 10 pips, and this is 100 pips, say for example, and you got 90% win rate, you're going to win, 9 times So for example, 9 times. So you'll win 90 pips, but then you'll have one trade that'll hit the stop loss, so that 90% cancels itself out and you lose anyway. So all of that, you know, ridiculous work and sitting through this ridiculous drawdown from these ridiculous traders and signals that are really just clueless and really don't care about your money, you know, it was all just a waste of time. So let's go back onto the sheet. So top tip, this is where the indicator comes in, guys. You can use weekly, previous weekly, monthly highs and lows as D-point confluences too. So if we get this indicator on here, it's just called high lows on TradingView. You'll see here, previous weekly high, previous monthly high, weekly high, etc., etc. These are good zones of support and resistance. So if you find that a D-point, you know, lands on one of these lines, and within a demand zone as well, you know, this gives you even more confluence. But as I put on the sheet here, you only need one of the two. You know, if the pattern completes inside a supply and demand zone, awesome. Higher the time frame, the better. You know, the more potential strength and liquidity that's got behind it. Or did the pattern complete on a strong resistance, support or resistance, I should say. Support or resistance zone, weekly, low, high, etc. That's where the indicator comes in. Even if it, the harmonic for some reason didn't land on an order block or supply demand zone, etc., etc. If it landed on one of these zones here, you know, you can be fairly confident here that, you know, you're going to get a reversal or some kind of reaction at your D point because it's testing a previous zone of, you know, support resistance. So you can see here this D point actually landed in. If you get both of them, awesome. It's even more, you know, even more of a confirmation for your higher time frame. So what you can see here, look, if we go down, what can we see? You know, we can see D point overextended the D point. If we go on the higher time frame, this would have just been wicks. But we can see here, look, if we delete the indicator, let me just remove that. It landed right on the weekly low. That would have actually been a different weekly low because it's on a different week now. But it's you'll find that these zones act as good support and resistance, and they're constantly retested. So it's really good to you know, leave this indicator running. So you can see here, look, 1, 2, 3, 4. The fourth wick, look, it came below all of the other wicks, which means that wick there took liquidity. What was you saying over here? And then you can see, look, after that one, it took off. So after that wick there, you could have entered here long with that candle, stop loss under that last wick, and then you could have taken this trade all the way up here. Really, really good risk reward there. Small stop loss, and it wouldn't have even come back into any drawdown either. So that's the power of looking at these, or looking for these, you know, 3 to 4 weeks of reaction at the demand zone. That's why I say you don't need, you know, to zoom in and start messing around on low time frames if you're you know, a beginner or you're new. Just keeping things simple will keep your win rate basically the same. You know, the only reason people go down time frames is to get, you know, tighter entries and better risk reward, and that's it. But your win rate can be literally exactly the same. Like if we zoom down on this, like it becomes more complicated, you know, the market becomes choppier, etc., etc., and it's easier to get confused, especially at first. But you can see here, you know, we had 1, 2, 3, you know, 4 hits to the low here. 1 second, let me get this out. So we've got 1. I mean, class this as a Wyckoff, a distribution. Just put 3 1s for the minute, for the time being. All right, okay, so we've got 4 here. This can be the spring. This would be a test in phase B. Oh, that didn't work, did it? Why is that still saying 1? I've put it as 2. Oh, went in the demand zone. So, there we are. And we can see here, look, you'll always get, again, on the low time frames, if you're interested in this with a Wyckoff, you'll always get a sign of strength like this. This is a fake out, and it happens with the accumulation and distribution. Basically, you'll get a sign of strength or a sign of weakness, and what will happen is price will push out. So it induces buyers, you know, oh, it's going long, it's breaking out, and then what it'll do is it'll push down for the spring, liquidity hunt, and then the main move comes again. Exactly like what I said over here, if you remember at the beginning, how they manipulate the market here. So you've just seen a live, you know, real example of that, you know, down here. And you'll find this happens. You find that the market moves in cycles. You know, you've got the accumulation, markup, distribution, markdown first. So you'll find that the market moves like this. I've got you know, a few videos on this in the free course. I'll leave the free course video below. So the market moves. Get on the pen there. It moves like this. And this is the accumulation, where you'll find the. This is where you'll find the entries. This is where you find your Wyckoff or your breaking momentum, etc., etc., or your 3 to 4 wicks. You'll always find the 3 to 4 wicks 99% of the time, in these zones. And you can see the market moves in cycles. Here, you can see it if you just look at the charts. So you can see here, moves, cycles, cycle, 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 cycle. And, you can zoom down the time frames and catch all these smaller cycles, etc. But you can see how it moves. And inside these cycles, you'll be able to find these 3 to 4 wicks, you can zoom in on lower time frames, etc., etc. But this video isn't for zooming in on lower time frames. It's just to familiarize yourself with how to use, let me get rid of them, harmonics and how to leverage the D points. So if you see a D point completion landing in a strong unmitigated supply and demand zone, that's also landing on a current previous weekly high or low, you've got a strong probability that price will reverse at this level. However, you don't need both confluences, you just need one. All you need to do then is be patient and wait for the low time frame, setup or the wick rejection. So wait for price to tell you where it's going. Don't try to force it where you want it to go. So we wait for the confirmation here. We wait for the D point to complete. And remember, you can do these on any time frame, guys. You don't have to wait, you don't have to set it up on the monthly time frame, for example, and wait 3 months for it to, come in. You can set these up, you can look for these on the week, the 15-minute chart. You can find harmonics almost every day. The higher the time frame, the harmonic, the higher probability you can expect a larger reaction. So if you see higher time frame crab, for example, or something like that, just about to complete in a strong supply demand zone, etc., really overextended price action, and then you start to see price stalling out, and then you start to see like a distribution like this happening, you can then start to expect this form of movement here. Not always you're going to get liquidity hunt, but if you do get the 3 to 4 hits the high like this, and then you see the sign of weakness, don't fall for the sign of weakness there unless you've got experience and you can scalp that sign of weakness, because you always find, or 90% of the time, you'll find that if you buy this breakout or sell this breakout here, it's going to go down. Maybe you'll catch 20 pips, 50 pips, whatever, but you'll always miss not always, but a lot of the time you'll miss the main move. Price will come back up, hunt this zone, hunt at least to test the highs again, before then the main move, continues down. I mean, when you get more experience, you can catch both of them, etc., etc. But it's all about using, the harmonics to find a potential zone of reversal, looking, stacking up them confluences here that we've got. So I've got a checkpoint, a checklist here for you. So, did the pattern complete? If it's only got to here, it hasn't completed. Even if you do see, it might be reversing, etc., etc. If you're not an experienced trader and stuff like that, you don't want to be, risking setups or just jumping into the market for the sake of it. You want to be waiting for the confluences to confirm and line up, because once they line up and then you get your setup, you've got a high probability entry there that's probably going to work out in your favor, and that's how you build confidence. You're not going to build confidence if you're taking, it's almost got to here, and it's overextended there. I'm just going to say, I've seen a little thing here that looks like it. No, you'll see a lot of things that are there to trick you in the market. And if we wait for our solid confirmations, if we wait with our plan here, and we only take this, then you build trust in your plan. Then you see how it works. You see how many pips you make. You see your win rate, your loss rate, etc., etc. And then you start to actually, build consistency with your trading instead of just taking, random shit from all over the place just because it looks like it might go in your direction, etc., etc. You need to start with a solid plan, before you start even being consistent in the market. The plan brings confidence. The plan helps you with your mental game, etc., etc. And then what you've got to do, guys, is not over leverage either. So you want to start off, if you're trading this, for example, these are high probability. But for you, they won't feel like high probability. You'll feel, panicky. I need to have a profit as soon as I'm in, etc., etc. No, you need to trust the trade. And if you're feeling emotionally attached to a trade, you've got too much in that trade. So you need to take some money out of that trade. Only use small lots. Only use money you're prepared to lose. And then do 20 of these trades. Be patient. You can catch one every day, 2 or 3 every day. If you go through the charts, mark up, find one pattern that works for you, learn it. Mark up, wait for some D points to happen. Make sure you've got your confluences here on the checklist. Is it hitting higher lows? Is it in supply and demand? Yes, 2 confluences there. Is price stalling out? Is price failing to create, new highs? Is price, losing strength? Is it breaking momentum? Yes. And all you've got to do is wait for a setup that looks like this, where you've got, failed highs, it's failing to break the highs here, sign of weakness here, internal breaks of structure, liquidity hunt to the top side, and that'll be your confirmation there. 3 to 4 wicks to the high is the easiest, or 3 to 4 wicks to the low is the easiest way to, see that. And if you just take this for an example here, just go back on the higher time frame. Where have you gone? There you are. If you just take this example here, and you just memorize this, once that 3 to 4 weeks has happened, at the D point, in the demand zone, at a weekly high low, if that's there, it doesn't need to be there, but you've got your 4 wicks there, look. And that wick right there took out any liquidity from that demand zone, took out anyone, that basically bought this breakout here. They probably saw this internal breaker structure here. They would have put their stop loss. They would have put their stop loss. They bought here. They'd have put the stop loss, up previous lows here, going in their favor. And then as you see there, look, they just get wicked out. Or if they, were super optimizing the trades on low time frames, they'd have probably gone below that low. And then look, they get wicked out, and they missed the actual move. They might have caught a few points there, but then they missed the real move because they weren't patient. This is again why you need experience to go down lower time frames and understand them. Otherwise, it can be confusing. Otherwise, you find yourself get wicked out. So if you just stay to the higher time frames while you familiarize yourself, we've got 1, 2, big sign of strength there, push up. We've got some breaks of structure internally. It didn't break structure on the hourly because it didn't close past this wick here. But if we zoom down, we did have break of structure here on the lower time frame, which was a sign was going bullish. And then what we did have here is price come down, didn't break below our support here, wick below it, came back up. You can see here, look, engulfing candle, and then you could have entered. And this is what I'm saying, like, if you go on the lower time frames, look, you can get better entries. Like here, look, or from the higher time frame, we've got a 28 pip. This is a 10 pip, reduced stop loss, so we can get a higher risk reward there. And that's the only reason why you'd zoom down the time frames. But for starting out, and even for intermediates or whatever, a lot of people I know that are even like professionals and stuff like this, they don't even bother going below the 15-minute, anymore. A lot of people I know that used to go for these super, 1, 2, 3, pip stop loss entries, they spend more time getting, wicked out, and it's, I find it, pretty pointless. I do like to go down to the 1 minutes, 3 minutes, etc. to confirm entries, but, I don't go under really a 6 to 10 pip stop loss. I'm not really bothered about super, optimizing it, hitting the stop loss double the amount of time for, half of the, to make my stop loss 5 pips instead of 10 pips, etc., etc. I know that I can use a 10 pip. Or most of the time I can get a snipe in there, and I know when the trade's good in my favor. I trade pretty uniquely. I've got a really good feel for the market, and again, instinct plays a big part in your trading as well. You'll find yourself, especially if you're over leveraging and you're new, you'll find yourself hesitating, and hesitating is one of the biggest things that stops people becoming successful in trading. If you're if you see the setup there and you're like, oh no, I don't know what to do, I don't know how to pull the trigger, reduce the lot size. You've got to trade like a robot, and if you are finding yourself hesitating and stuff like that, you need to go on a demo account, practice on there, and then come over to a live account when you've got money that you can afford to lose. Because when you've got money you can afford to lose, you don't care about it, there's no emotional attachment, you're not going to be hesitating, etc., etc. And then you can slowly incrementally increase your lot sizes, your risk, etc., etc. Once you've done your sample sizes, once you've done 20, 50, 100 trades with this, once you've started building confidence and see it working, then you'll just naturally start growing. Remember, there's no rush with this, guys, and you've got this Confluence checklist here, and you only need, again here, look, one of the bottom 2 to be confirmed. So remember, if it completes in a higher time frame supply and demand zone, awesome. Or if it completes on strong support and resistance, awesome. Weekly high, weekly low, etc., etc. Or if it completes on them both, awesome. Well, one or the other is fine. So if we just go back on the charts now, I've drawn a few more harmonics here. Just higher time frame. Like, you can just go through the charts and find these. We'll do some freestyling in a moment. So what I've found with harmonics a lot of the time is your D point measurement always wants to be accurate. In regards to these harmonics here, when it says you've got the 3, if you see the bearish bat, and this was something that confused me for a long time, you've got the 382 to the 50%. It can be anywhere in between the 382 and the 50%. It doesn't have to be exactly 382 or 50%. It's a range. It's the same with all of them. But the D point has to be at least within 5%, of that 886. The same with the crab here. It can be anywhere between the 382 or the 618. The same with any of them. The shark, it can be anywhere between the 886 and the 1.13. It can be anywhere between the 1.13 and the 1.618 here. But you will find that on the sharp pattern, especially with the D point, the 886 and the 1.13 will always be within 5%. So if you're like in the middle of a 0.86 and a 1.13, you'll normally find the market like messing around a little bit, and it's waiting to basically do this. You'll see it basically waiting to do this. It's just playing with your mind, and that's what it does the best. It's basically doing this. So you'll find it waiting at the 886 here. It's messing around. You're like, oh yeah, I've got a good sell. And if you've got a sell here, awesome. Just make sure you take your profits, etc., etc. Follow your plan. And if you're getting a sell here, you can normally expect it to pull back and then probably wick up to that 1.13. And if you see a setup like this, guys, it's just literally cash there all day long. And obviously you can draw a line up. You can see it'll break momentum, it'll retest momentum, or retest the trading range here, and then it'll just continue down. So that is, really it for the Harmonics video. As I'm saying, I'm going to do some freestyling. We'll go through some now, just so you can see the D point reactions here. The 886 here. These are the shorter B points. So we had 886, and this is why we wait for the confirmations. Like, look at this. We had like a V reversal here. So you can see price stabbed down here and then instantly reversed back up, and it actually broke structure. Look. So what you could wait for in this scenario is we had it closed above the wicks. Look, so it broke structure there. So what we can expect now is every time price breaks structure, it's got a retrace. So you can use your fib here, or you can use this. And I like to take trades off the 50%. So you could wait for the 50% here. So you've got the D point, 50%. Let's put our indicator on here. This is an entry when you don't get the Wyckoff, the accumulation or distribution, or the wicks. When you just get the V-shaped entry, it's more difficult to catch, and you've got to have more trust in your trades. So in the beginning, it's probably not the most ideal one to be learning. You can backtest it first by all means. But look, you can see it came very close, to the previous weekly high, weekly low. That would have been different at the time, obviously, but these are still good. These would have still been probably similar zones of support and resistance anyway. So we've got the 50% there. So we could have waited for price to come back in 50%, and then just taking it up like this. We've got a break of structure. So what do we expect after break of structure? Impulse, retracement, impulse again, and then retracement. And we've got a butterfly here. Look, perfectly completed butterfly there. As you can see, if we go to the bearish butterfly, where are you? 786. It's within 5%. Anywhere between 382 and 886. So that's perfect. Look, we're in between that range. And then the last one, 1.272. Right there, within. That's a perfectly completed butterfly. Look, it's broken structure. It's broken this swing point here. So what can we expect? After it breaks structure, we expect a pullback. And look, we've got, if we go down to the 1 hour on the D point of that butterfly, what have we got again? The first wick was actually higher, but we've got, remember I said the market moves in cycles, remember? Moves like this, so down, up. You can see it now as it comes up and then it moves down. And you see, look, this would be failed highs. So a D point, and the D point is landing, we've got to make sure, look at the checklist. The D point is landing in a, let's put a line there. So the D point is landing in a nice supply and demand, in a nice supply zone there. Previous double top. Price probably wicked that liquidity before. Price probably wicked this liquidity before it went down. We'll have a look in a moment. So if we put the arrow right on this liquidity here, we've got an unmitigated zone there, order block there, that actually went down and caused all of this, price movement here, breaks the structure, breaks the structure, breaks the structure. So it's a strong point of liquidity in the market there. Yeah, look, you can see. You see the liquidity there? We've got a double top here, that's liquidity. So that would have acted as inducement, and we've got the first wick, which took out that liquidity at the D point. So we've got all of our confluences here. The only thing we're then looking for is, let me just put it this one, is we want to see our 4 wicks. or candles. We've got 1, 2, 3. We've got 4 there. 1, 2, 3, and then the fourth one is lower down. This one would be more difficult to catch. This is why I'd personally used a lower time frame. You could have taken it straight from the D point. However, that is riskier if you do that without waiting for, you know, proper confirmation. And now I've lost it. Where's it gone? There. So we've probably had some internal breaks of structure here, which would give us an indicator. This is where we can, you know, use the lower time frame to our advantage here. We've got the first wick. So the wicks will always go in order. You'll always get that, you know, liquidity at the top. This was actually the liquidity first. And then we got a failed high. You can see here, when the candles are failing to break the high, price is struggling to go any further. So that's a good indication, especially if you've got low time frame breaks of structure here, that price is going to, you know, continue down because it's losing momentum, it's losing strength. You've got the D point here, you've got, you know, overextended price action, and it needs to come down. It needs to come back down. Not only to mitigate unmitigated orders, but also to capture more liquidity. So we've got, let's say, look, we've got our distribution here. We've got this would have been breaker structure here, and you can see, look, another very nice place to enter here. Just put the Asia one on there, the blue one. So you see the, let me just replay this, put it here. There we go. Now I can go on the 10-minute, hopefully. Yes. So we had 10-minute structure here. This was a big bullish push. So this one, ideally, your safest entry, if you was entering off, you know, the 10 or the 15-minute, would be when this structure is broken here. So you could have entered here for your safest entry, because this was technically still bullish. You see this big bullish push here. So everything inside this range that was going on was still bullish. Yes, we could see that it was losing momentum, losing strength. However, it's just stuck in a complex pullback. So it could have quite easily, you know, gone to the upside. So here, for the safest entry, we've got, again, look, price coming down. It was creating liquidity here, getting people selling. Again, you see the 1, 2, 3, 4 wicks there. Look, that wick. Nice fourth wick there. And what that did, look, is it broke structure. Now, ideally, you know, a really good entry would have been waiting for that to come back up here, test again, and come down after the break structure, but it didn't. But what you see here, look, is, let me just get rid of that, is once it breaks out of this zone, it breaks the structure on the 10-15 minute and candle closes below. You can see here, we've got, you know, 3, 4 wicks here that are all testing that range. And when you see these failing here to break back into this range, you can pull the trigger there. And look how far this trade would have gone, you know, straight from that D point. Let's get rid of the replay now. Look how far it would have gone. You could have taken it all the way down here, and you wouldn't have got any drawdown whatsoever from that. You know, so that's the basics of Harmonics. I don't want to keep it running all day. Make sure you follow the checklist. Remember, we use Harmonics on the higher time frames, ideally 15 minutes and above, you know, to give us a directional bias, or to use as a PRZ. And remember, if we're trading from the D point, you know, we need the pattern to complete. We need the D point to complete, you know, within our zones here. You know, you've got this on the Google Drive. We need the 3 or 4 wicks. You've seen the 3 or 4 wicks there. If they don't come, or you're unsure, don't take it. There's no point. You know, it's about following a good process. It's not about making money. And making money is a byproduct of the process. If you're not following a good process and you're just making money, or you're gambling, or you're getting lucky, you know, that's not building, you know, your account. That's just a short-term win, giving you a bit of a dopamine rush that you'll end up just losing it anyway. You know, so follow the process, follow the plan here, and just stick to that, and you will make money with it almost every time, as long as you wait for the confirmations. And remember, these confirmations will mostly arrive or come during the London Open, New York Open, or the London or New York sessions during the heavy news. They'll use the heavy news, the market makers, to push the market and make it do crazy moves like this, trick people to go long, trick people to go short. But if we know the true intentions, guys, you know, we can be one step ahead of them, and we can trade, you know, with the guys, you know, that are moving the market. So that's it, guys. If you've got any questions or anything like that, let me know in the chat, comments, wherever you want. I'm available. Obviously, there's the free course below the video. There's a lot of things below the video, links and stuff like that. So yeah, that's it, guys. Have a good day. Any questions, let me know, and enjoy trading with Harmonics.